Actually, I'll tell you what. Why don't I introduce you and let you? I'll do a quick intro and let you take it from there.
Okay, awesome. All right. It looks like we are live and ready to go, Dave.
All right. So we have guests already in the room, or are we letting those in?
Looks like we already have a handful of people.
Okay. All right. Well, thanks for joining us this morning. I'm Dave McClure, founder and managing partner at Practical Venture Capital, and Daniel Blake, who's the founder and CEO of UI Charitable, is also with us. And we're going to tell you guys how to save millions of dollars in taxes. And that's not just a crazy pitch. Personally, myself, I have booked more than $5 million worth of tax credits using this strategy in the past couple of years, and probably a little bit more in the next few years as well. So this is a real strategy, and we'll give you actual case studies of people who have saved 6 and 7 figures by using this method. Uh, Dan, could you give us a brief introduction to yourself and UI Charitable, and then maybe we can talk a little bit about who we're talking to today and what we're going to try and explain.
Yeah, absolutely. Like Dave mentioned, my name is Daniel Blake. I'm the CEO here at UI Charitable. UI Charitable, we really think of ourselves as a philanthropic back office for high net worth individuals and institutions. And so we focus on making sure that your giving is structured in the most tax efficient way possible, as well as making sure that you accomplish the charitable outcomes that you care about.
Terrific. I'm not sure who's running slides, but if we can jump, there we go. Yes.
Yeah. So, like Dave mentioned, we're going to run through a couple of strategies that are very well documented strategies, but aren't very well known. So, the IRS has very clear rules on how these strategies work. Um, and there's a tremendous amount of value being left on the table specifically for investors and founders. So we're just going to go ahead and jump right into it. So the problem that we're looking at is for individuals that have privately held illiquid assets. These can be very difficult to sell. The value of the asset on paper is generally going to be very different than what you can actually sell it for. Currently, we're seeing assets like these LP interests, founders' equity. If it's sold in a secondary transaction, it's oftentimes sold at a very steep discount.
And I can attest to that as your greedy buyer of secondary shares. We are tough negotiators. In many cases, the discounts that we're buying individual equity in companies is 30 to 50%. For fund interest, GP and LP interest, sometimes that can be as high as 50 to 70%. And so part of this strategy is really just to show you that by doing a donation and tax deduction, depending on what state you live in and what tax rate you're paying at, oftentimes you can save more money in taxes than you would get from trying to sell a tough interest on the secondary market.
And so the thing that most people don't realize is just how easy it is to donate those privately held complex assets. By donating those assets, you get a tax deduction based off of the fair market value. You avoid capital gains when those assets are sold. And this is a fantastic way to increase the funding for your charitable goals. So this looks like a lot of numbers. My apologies for that, but I do want to illustrate the power of this strategy. So we are going to assume that you are selling a business that's worth $10 million. This first column is what most people do. They sell their business and then they say, I owe a lot of taxes. I'm charitably inclined. I'm going to donate, in this example, $2 million. They donate $2 million of cash after they sell their business. And so what you should do is you should make the donation prior to the sale. So I'm going to walk through this chart very quickly. Again, my apologies for all of the numbers, but this I want to make sure that everyone's really clear on how powerful this strategy is. So in both scenarios, you're selling your business for $10 million. In the good column, donation before the sale, you are going to donate $2 million of equity prior to the sale. We're going to assume you started the business, you have a really low cost basis, say $100,000. So this second arrow, the kicker here is you just lowered your taxable amount from $9.9 million to $7.9 million. Because of that, instead of paying $2.6 million in capital gains taxes, you're now paying $2.1 million in capital gains. You just saved $500,000 by changing the timing of your giving, by donating in kind versus donating cash after the sale. So then once the sale happens, you're not making any additional donations. And so if you look at the final equity plus tax savings in the donation after the sale, $6.2 million. The donation before the sale, your final equity plus tax savings is $6.7 million. So by simply changing the timing of your giving and donating the asset in kind versus making a donation with post-sale cash, you're saving $500,000 in taxes off of a $2 million donation. I mean, there are very, very few ways that you can find these tax savings with just about any other strategy that's out there. Dave, is there anything that you'd want to add to this?
I think maybe just one thing for folks who are not familiar with donor advised fund structures or DAFs, that $2 million is not necessarily that you're picking a charitable entity and making that donation and having to figure that out in advance. When you set up your own donor advised fund, it is itself a nonprofit entity and you get that tax deduction immediately when it's in your donor advised fund. You can make decisions later about where you make grants to and who you make grants to. So that $2 million in donations is actually going into your own philanthropic account. And depending on what you do with that and when that liquidates, you can make charitable donations. You can even make other investments within your DAF along the way. Dan, I don't know if there's a way that you can share your screen a little bit larger. Maybe you're sharing a window instead of a tab there, but that screen share is a little bit small. If you can make that more easy for people to read. Yes, there we go. That's much better. Terrific.
All right, perfect. So, and that's a great segue into this next section on donor advised funds. Dave just gave a great explanation of donor advised funds. So a donor advised fund really is an alternative to a private family foundation. So it's like having your own charitable investment account. You donate to your donor advised fund, you receive an immediate tax deduction. The assets in the donor advised fund can grow tax-free, and then you can give out of that donor advised fund over time to any nonprofit or most social ventures. It is important to call out that a donor advised fund is a separate public charity. That's how you receive your tax deduction. And so you are the donor advisor, and the individual donor advised fund is going to have specific rules and guidelines that they follow. So it's really important to understand who is your donor advised fund host, and do they have any additional restrictions above and beyond what the IRS allows. At UI Charitable, we really pride ourselves on giving donors all of the flexibility that's afforded to them by the IRS. And the power of a donor advised fund really is around the separating the timing of your tax deduction from the timing of your charitable giving. And by separating those two things, you're now able to optimize for both of those.
I just wanted to point out something that Dan mentioned on that previous slide. Dan, if you could go back 1 second there. So you mentioned this is an alternative to setting up a family foundation. That's a really important point. And let me just tell you that setting up a family foundation is much more of a pain in the butt and a lot more challenging. There's a lot more reporting. I'm saying this because I've done both, and I wish I had not set up the family foundation. I wish I'd just gone straight to setting up the DAF. And it's a lot easier to manage a lot of this within a DAF. Also, for a personal family foundation, usually doesn't make sense unless you have at least $1 million or more to set up a family foundation. DAFs are much easier to set up and much lower dollar amounts. Dan, I don't know what the smallest DAF you've ever managed to set up, but I believe it could be less than $10,000 if people want it.
Yeah, I mean, we
one
have DAFs.
other.
Or go ahead, Dave. I was just going to say we have DAFs that are as small as thousands of dollars.
Yeah, and I think the other thing that to mention here is, although the charitable grants are emphasized, you can still manage investments inside your DAF in any type of vehicle that you want, and we'll talk later about. You could even transfer in crypto assets and hold and invest crypto assets. I've personally made startup investments and even fund investments out of my DAF. You can put those in normal public stocks or indexes. You could do any kind of transaction for the most part that you can do within a normal for-profit vehicle, just that this is happening within your charitable entity.
The only thing that I would add to that, donor advised funds are essentially twice as tax efficient. The tax deduction that you receive, depending on the asset, can be upwards of twice as large compared to a private foundation. So not only is it easier to set up, easier to manage, but donor advised funds are generally far more tax efficient than a private foundation. Most people also don't realize how flexible donor advised funds can be and everything that you can donate into a donor advised fund. When most individuals that already have a donor advised fund, they are contributing cash, they're donating public securities. And that's fantastic. You should do that. But they don't realize that you can donate private company stock, GPLP interests, precious metals, cryptocurrency, real estate, essentially any asset that you can have appraised by a third party, you can donate into a donor advised fund. And so when individuals—
Can I interrupt you for 1 second? And I would just say, you're actually telling a little bit of a lie there. Not every donor advised fund can accept these. And in fact, most donor advised funds will not accept private company stock, GPLP interest in a fund, and cryptocurrency. So that's a particularly special attribute of UI Charitable. I guess I'm selling here because I am a customer as well. But contributing private company stock, and in particular holding it in the same form after you've made the donation into your donor advised fund, and same thing with GPLP interest and crypto, is not typical for most donor advised funds. So although we can say here that you can do this into a DAF, you should check which DAF platform or sponsor you're talking to, whether they allow that. Many of them do not. Many of them won't accept illiquid assets, and many of them will force you to sell those illiquid assets if they do accept them. So that's really a particularly important point that we're talking about here for UI Charitable, is that they allow illiquid asset contributions like stock or fund interest or crypto, and they allow you to hold them in that same form after you've contributed them to your DAF.
Yeah, no, that's a great call out. There are hundreds and hundreds of individual donor advised fund platforms, donor advised fund sponsors, and they all do have very different rules and additional constraints that they've placed on themselves. Again, at UI Charitable, we think it's really important that if the IRS allows you to do it, you should be able to do it. And so again, at UI Charitable, we will allow you to donate essentially any type of asset that can be appraised by a third party. And that requirement of having the asset be appraised by a third party is simply because that's the IRS requirement for non-public securities. So what does this mean for founders and employees? Again, I think there's a tremendous opportunity here. So if you are a founder, if you're an employee of a high growth startup, you are going to be holding a tremendous amount of illiquid wealth. And on occasion, you are going to have very meaningful liquidity events. And those liquidity events create a one-time tax planning opportunity. If we go back to the first example that I shared of the business selling for $10 million, that doesn't happen every day. That's a large transaction. You have to get the timing right if you want the tax savings. So if shares are donated in kind prior to a sale, you receive a tax deduction in the year of the donation, and that's based off of the fair market value of the asset. And then you also avoid capital gains on the shares that were donated into your donor advised fund.
And I should mention, in a special case, Dan, that might not just be capital gains, it might be ordinary income. And for many people in the Bay Area who are going through secondary sales, tender offers, or selling those shares themselves, especially if they have to exercise their shares and sell them in a short period of time, you're going to have a very large tax bill to pay. And sometimes people aren't aware that they'll be paying at the maximum ordinary income rate, which might be 39-40% at the federal level, could be 10% or more if you're living in California, New York, or Massachusetts. So sometimes half of your gains will end up going to taxes if you're not doing tax planning carefully. But you could probably cut that by half, at least at the federal level, if you do plan ahead.
The opportunity is massive, but the timing is so important. I mean, if you miss the window around timing, if you don't do this in kind and you sell your ownership, you've booked the ordinary income capital gains. That's irreversible. You now owe taxes. So the order of operations here really matters. So, and again, it's a super simple process. Donate the non-public shares in kind to your donor advised fund. It maybe takes you 2 or 3 minutes to set up a donor advised fund. We will help you craft the legal documents to transfer the asset into your donor advised fund. We'll walk you through the process once those assets are in your donor advised fund, you can either hold them, like Dave mentioned, or you can sell them. If you do sell them, the assets are sold tax-free, and then you have cash available to support the charitable causes that you care about. So again, most people just don't appreciate how simple this process can be to donate non-public shares in kind prior to a liquidation event. So that's founders and employees. There's also a tremendous opportunity for investors. So, this is if you are a GP or an LP. This is also true if you have a direct investment in a company. So when donated, the IRS determines the value of your tax deduction based off of the fair market value, which is going to be determined by a third-party appraisal. That is oftentimes very different than what you can actually sell the asset for. So, and Dave, do you want to talk about kind of the
I was going to say, you're being pretty subtle here, Daniel, but the scenario is you can often get that fair market value appraisal at a much higher number than the market will buy that asset for from you. And in some cases, there really may not be a buyer at all for the asset. Again, I can speak from personal experience here, not to mention any particular companies or funds, but many of us might be holding investments in overvalued companies, busted unicorns from 4 or 5 years ago, where the on-paper value might be $1 billion. The actual value of that company might be a lot less than that. In fact, I would say again, you might have a price for a company that's half that on-paper value or less. For fund interest, it could be a third of the on-paper value. It can even be zero because there are no buyers. So something we often say in jest, but it's really true. The IRS is always a secondary buyer of last resort. And what we mean by that is you can get a third-party appraisal, and oftentimes that will be at the on-paper value as reported by the company in their most recent financials or by the fund manager in their last quarterly report. You would go to a third party to get that appraisal. That's a fairly quick process, can usually be done within 30 days, sometimes even faster. And if you've ever watched the 1-800-CARS-FOR-KIDS commercial, or if you've ever donated clothes to Goodwill, oftentimes those folks will give you a receipt for your donation. That's a very optimistic value for your car or your clothes. That's not any different from what we're talking about here. I'm not asking anyone to misreport or to try and play games with the IRS, but as long as you get a third-party fair market value assessment, they will probably use that last reported public funding round or privately reported quarterly financial statement as their initial place to start beginning their homework. And sometimes you can get it for 100% of that value on paper. That might be a lot more than you would get in trying to sell it on the public market, and certainly for fund interest, that's true. Dan, I think you probably have some math on the next slide that explains that.
Yeah, I just want to hit on this point one last time. For the tax deduction, the assets are valued at the fair market value. That is locked in when you make your donation. So whatever happens after that is independent of the value of the tax deduction. So that asset may rise or fall in pretty significant ways after you've made that donation. If it increases in value, you don't get an additional tax deduction. Again, the tax deduction was locked in based off of the third-party appraisal and the fair market value. If the value decreases for whatever reason, again, it doesn't change the value of that tax deduction. So this is a very simplistic model. So two options. You have a GP LP interest. On paper, it's worth $1 million. You can go get that appraised and donate that to your donor advised fund. You're going to receive $1 million tax deduction based off of that fair market value. If you sell it inside the DAF, you avoid capital gains. It's another 20% savings versus selling that in a secondary transaction. You might be selling that for 50 cents on the dollar, 30 cents on the dollar. If you sell that, your $1 million LP position.
There might not be a buyer. And the value you get is essentially zero.
Yep, absolutely. So, maybe here we're being optimistic. You sell it for $300,000. It's a 3x increase. And in many cases, it's going to be significantly larger than that. So again, there are hundreds of thousands of dollars that all employees, all founders, all GPs, all LPs are leaving on the table by not understanding this strategy.
Yeah, no, I'll maybe just talk personally again from my experience. There's probably two scenarios. One where you have some assets that you think are probably optimistically valued or, maybe going to go lower in value in the future. You can have certainty by donating those assets into your donor advised fund and locking in that tax deduction at the, most optimistic value that you can get from a third-party fair market value assessment. It might go up, it might go down. If it goes down, you've locked in your tax deduction and savings at the point of donation. If it goes up, worst case scenario is you have more money in your philanthropic pocket to give for charitable causes or to invest, which isn't the worst thing. So again, I want to make the distinction here. You're not necessarily giving this to someone else at that point of donation. You're giving it to your own donor advised fund. It's still under your direction to some extent and control. It's not your personal money, but it is part of your philanthropic account. And you can still hold that asset if you think it's going to appreciate. You don't have to sell that right away. So you might optimize for that potential upside within your DAF.
Absolutely. A couple of details just worth calling out. The deductions of an illiquid private asset are capped at 30% of your adjusted gross income. If the deduction value exceeds that 30%, the excess tax deduction can be rolled forward for up to another 5 years. And so again, just a lot of flexibility here when it comes to tax planning. The things that you do want to consider, regardless of, if you are a founder, employee, GP, LP, this only works in this particular case if you have a US tax exposure. There are things similar to DAFs in other countries, but if you don't have any US tax exposure, this isn't going to be a strategy that you should be pursuing. And then you also need to make sure that you can get the GP or management consent to actually transfer your ownership interest into the donor advised fund. I have gone through hundreds and hundreds of these transactions, and I can maybe think of a single transaction where we couldn't get the GP or management consent to make the transfer. The process, again, is much simpler than people realize. You select the asset, We will then help you do due diligence on that asset. The due diligence really is around the consents needed to make the transfer. We will then craft a gift agreement that takes into account any of the consents that you need to make the transfer. You then execute that gift agreement. You need a third-party appraisal to determine the fair market value of that tax deduction. When you file your taxes, you're going to file what's called a Form 8283. You sign it, the appraiser signs it, and your donor advice fund is going to sign it. And that's really the entirety of this process. It is, again, like I mentioned, just much simpler than most people realize. Dave, you've done this now, what, half a dozen different times?
At least I would generally say it takes between 2 to 4 weeks. Most of the time is really getting the appraisal scheduled and lined up with the party to do it. For more complex assets, it might take a little bit more time. So a fund interest might take a little bit more due diligence and appraisal than a single asset. If it's a single asset with the company, and you have a recent, company financial or quarterly statement, it's probably fairly straightforward to do that process. And again, yes, I've done this personally at least 3 or 4 times. We've done it with some of our clients multiple times as well.
And this is going
just
down
one thing I wanted to go back to on the previous slide, just for calculation purposes, Dan. You mentioned 30% of your adjusted gross income rolled over 5 years. So the basic calculation you should probably make is how much money you're going to make in the next 5 years, both in terms of ordinary income and investment income. Add those numbers up for 5 years, multiply by 30%, and then go find an amount of assets equivalent to that amount that you can donate, so you can maximize and hopefully not pay any taxes for the next 5 years, at least at the federal level.
Oh, that's great. Thank you, Dave. We've talked a lot about investors, founders, private business interests, GP, LP interests. I also want to call out just cryptocurrency. This is another asset that you can donate to a donor advice fund. Again, you should donate it in kind. There are many donor advice funds that will accept cryptocurrency. The vast majority require you to immediately liquidate that cryptocurrency. We're different in the fact that we allow you to hold whatever token it is. Absolutely. Yep. Whatever token it is that you have. And then we are also very unique in that we are currently the only donor advice fund that will allow you to grant it out in kind as well. And so you are able to stay on chain for the entirety of the life of your donor advised fund. So again, just far more flexibility here than many people realize.
I think this is important for folks who might have been early in crypto and are sitting on top of a really large taxable event if they ever sell it, where they could donate a portion of that, not have any gains, and all of a sudden, then they could sell it within their donor advised fund for cash or hold it, but they can start doing a lot of other investing or charitable giving with those proceeds.
Absolutely. Again, process is very simple. Go through, identify what token it is you want to donate. You move that into your donor advice fund. You receive an immediate tax deduction. You can then decide, do you want to continue to hold in kind? Do you want to liquidate and diversify? Or do you want to donate that to, whoever your preferred charitable cause is? Dave mentioned this at the very beginning. Not all donor advice funds are created equal. We pride ourselves, again, on giving donors all of the flexibility that's afforded to them by the IRS. So we will accept far more complex assets than the typical donor advice fund. We will allow you to continue to hold those complex assets where appropriate. If you'd like to sell them, you can. Once those assets are in the donor advice fund, Dave alluded to this, but there's a tremendous amount of flexibility in how you invest those assets. If you want to invest in public securities, that's fantastic. If you want to continue to invest in Private securities, you can. We have one really interesting case study where a donor donated their employee equity and then invested it in kind into another fund. So just a tremendous amount of flexibility in how you manage those assets. And then again, a lot of flexibility in the charitable causes that you support. So I require context. Let's look at two different case studies. So this one was a former executive, this should say, at a major social media company. This was pre-IPO. So this executive was looking at his holdings and decided he wanted to sell some portion prior to the IPO. As they were going through that transaction, they were doing their tax planning and decided, in addition to selling their shares, they should also set up a donor advice fund to reduce the overall tax burden. So they donated $5 million worth of their employee stock into their donor advised fund. They then went through a secondary transaction. They sold, a large portion of what they owned personally, in addition to everything that they had donated into the donor advised fund. Given kind of the quality of the asset, this was sold at a 0% discount, which I candidly, I think is pretty rare. And so they had $5 million cash go back into the donor advice fund. And so the individual received a $5 million tax deduction when they made the donation, and then avoided capital gains on the full $5 million that was sold within the donor advice fund. They now have $5 million cash that they can grant out to whatever charitable activity that they would like. The benefit of a donor advice fund is there are no annual requirements around how much you have to give. So if you want to give everything away in 1 year, you can. If you want to give nothing away in a year, that's also okay. So just a tremendous amount of flexibility there. And this second one, a founder of an $800 million tech company. This company had raised, $100+ million in capital. Founder donated $1 million worth of shares in kind to their DAF. They received a $1 million tax deduction for that donation. And then the thing that I think is really creative here is they took those shares and invested them in kind into a fund so that they could have greater diversification. In this particular instance, it was invested at a 20% discount. Given that all of that was done in the structure of a donor advised fund, that was all a tax-free transaction. Assuming this fund does really well, it's going to return more than $1 million into the donor advised fund, which again will appreciate in value, all tax-free.
I think one of the other things to note here, I'm pretty sure I'm familiar with both of these two examples, although they're anonymous. I think I was the referrer of these folks to UI. In the first case, not only was that cash within the fund given to charitable entities, but it was also used to make individual startup investments, and I've done that myself as well, both startup investments and my funds and funds. And in the second case, I'm pretty sure that was an investment in our fund. But one of the things I would point out was whether you invest in our fund or another one, you can still get diversification benefits as well. So one of the things that is typically the case when someone's donating a single company position is it's a highly concentrated asset. And so just like they might want to get diversification benefits in their for-profit pocket, in your donor advised fund, you might also want to diversify that position. So you might sell to get cash, but you also might, transfer it into a fund in a more diversified portfolio, and hopefully get some benefits from the other portfolio positions there as well. But I think it's really unique, specifically with UI, that you can manage and hold these assets in the original form. You can transfer them into other fund interests. You could do other, crypto investments or deployment. You could even do startup and VC fund investments within your donor advised fund. And again, personally, I've done more than $3 million worth of investments in startups and funds, and even fund of funds within my donor advised fund. I think we have one question from Karin too.
Yeah, I can read the question. Have you facilitated many employee secondary transactions? Isn't getting the cash to exercise the options a main constraint? Dave, I feel like you and I had a conversation about this last night.
Yeah, well, I don't want to lead the witness too much because we don't have this structured yet, but this is something we're working on where hopefully we will be able to provide some cash to exercise the options. And um, I don't want to make any announcements about that now, but there are employee forward contract platforms that do provide that type of benefit. We might also figure out a way that we can provide some partial liquidity within the DAF to illiquid assets. So I can't say I want to give an answer to that question just yet because we're not currently doing that, but that's something we hope to roll out within the next. I don't know, Dan. What do you think? 90 days? We'll see. Hopefully within the next quarter or two.
Yep.
But that is an important point, and one of the things that I will mention that's an example that I talked to someone recently about is many people hold their options unexercised, and if they are leaving a company, they may have a limited time frame to exercise those options. So, Karin's correct; they might need cash to do that exercise, otherwise they would lose those shares. If they want to have a lower tax rates on these shares, they might exercise and hold in order to then get capital gains treatment if they hold for more than 12 months instead of ordinary income treatment. So if you exercise and sell your shares right away, you're probably not going to qualify for capital gains, and that would typically be at a very high tax rate, sometimes the maximum tax rate at the federal level as well. So again, I don't know if we can solve all of these problems right away. Happy to talk to people about this particular example in more detail, but there are ways that you can work with employee forward contract providers. There are companies like EquityB and SecFi and ESO Fund and others that do facilitate financing the cost of exercising that option. They will typically keep some of the upside in the future liquidity as the way to pay for that. So the employee might not have to provide that cash, so thus they can, get a lower tax treatment and/or hold the shares after leaving the company. In those scenarios, would again allow you to make a donation or of a portion of those shares into your donor advised fund to offset any future tax bills that you might have or current tax bills that you might have. And we'll try and work on more flexibility. I'm sorry for being a little bit obscure here about this, but again, haven't finished all the paint on that particular program just yet.
Well, we are happy to answer any other questions that people have. Otherwise, like Dave mentioned, also happy to jump on individual calls with people if you have specific scenarios that you'd like us to walk through and explore with you.
I think I would just kind of summarize in basic elements for a lot of people is that they're probably holding, I would guess there's 10,000 to 50,000 people in the Bay Area, maybe more, that are holding $1 million to $10 million in a single company stock option. And that may sound great on paper, but it usually doesn't mean that you can use those shares to, buy a house or put down payment on a house or pay for kids going to college. Oftentimes, people will have to do a secondary sale if that's possible in order to, get some cash. Sometimes the company, if they're far enough along, may help you arrange a tender or a secondary sale. Those events have significant, tax consequences, and you may want to plan for those events in advance so that you can offset those taxes. I think Daniel's comment about making the donation in advance of that transaction is an important one. It's not always possible to do that after the fact. And it's not that hard to set up a donor advised fund and not that hard to make the donation. Again, it sounds like it might be a pain in the butt, but literally you can set up a donor advised fund within minutes, certainly within the course of one business day. You can get a fair market value appraisal within 30 days and possibly a lot faster than that and make the transfer. You do want to have enough time to plan for that so that it's possible to do it within, let's say, 3 months. You might need to notify or get consent from a company or a fund manager to make that transfer. So that might be the longest pole in the tent in terms of the time constraint. but certainly it's doable within 30 to 90 days with proper advanced planning. But you should probably do that before Q4 of your tax year that you're considering. You may find out in April that you have a big tax bill to pay, and you can't do it in the prior. You can't make donations in the subsequent year that offset taxes that you had in the previous year.
So Dave talked about how the longest pole, might be getting those consents. Generally, what we have seen happen is an employee will go to management, or an LP will go to the GP and say, "This is what I'm interested in." They kind of scratch their head and they say, "Why? What are you trying to accomplish? Tell us a little bit more about that." Once they understand it, they generally then take it out to all of their other LPs or all of their other employees, saying, if you are in this situation, this is a really elegant solution. So it's not uncommon for us having to educate the management team or the GP on the details of this, and explaining the nuances, and coaching them through it. But when we are able to do that, we see that it moves beyond a single LP, it moves beyond a single employee doing this, to many individuals at the fund or the company participating.
Yeah, and again, just to wrap up, I would say this is not a small tax implication for many folks. I personally have booked multiple millions of dollars in tax credits from donations that I've made, which is both great. I kind of like to brag about that a little bit, but I've also, made grants of over $1 million, not individually, but collectively amounts. I've made startup investments and fund investments that I used to make out of my for-profit pocket, now out of my donor advised fund, for several $1 million as well. And it's great to be able to do that with philanthropic dollars while also getting that tax deduction. It's kind of a double win. And this is entirely legal and straightforward and above board. You're not doing anything sketchy. Sometimes I tell people about this and they think there's some kind of catch. The only requirement is to get that third-party fair market value appraisal. And then that is what you would present to the IRS or anyone else to justify that tax deduction, as Dan suggested.
Absolutely. Well, Dave, it's always a lot of fun being on these webinars with you and walking through this.
Thanks for spending some time with us. Again, if folks have questions, feel free to ping us, and we'll be doing this again next week. If you want to tell your friends, we'll be hosting another one of these on Wednesday, March 4th next week. Same bat time and channel, I believe. And you can go to our website, practicalvc.com/DAF101 if you want to sign up for that webinar and potentially others in the future that we might hold.
Awesome. Well,
Thanks
thanks
a lot,
everyone.
Dan.
Yep. We'll talk soon.
Bye-bye.